Hey, what's going on, guys? This is Michael with Imperative Finance. So in this video, we're going to be going through a real estate pro forma. What are the imperative, important points that you need to know from a real estate pro forma, from a residential perspective, as well as a commercial perspective? And now the glory and also the drawback of real estate pro formas is that they are individualistic to who is making them, right? And so you'll see a lot of variation between a lot of different pro formas. The goal of this video is to combine all the knowledge, all of the assumptions that people make about pro formas, and round out that idea and show you here's the standards, right? Here's what people use to make decisions. So with that said, this pro forma that I've made is nothing like you've probably ever seen before, but it hits the important points and it's outlaid in this way so that you can understand the logic behind returns based off what information we have. So with that said, let's hop into this real estate pro forma. So first off, left side is your pro forma. Right side is your returns based on that pro forma. Now, the pro forma does not start until down here, but first off, we got to go over some deal metrics. Purchase price is $200,000. We have a loan amount of $160,000, which means we have a down payment of 40 grand. Now, within that down payment, 40,000 in the actual property, 5,000 that was burned to make the deal happen. So total mortgage payment per month is about $959. All right, we've also assumed income tax rates, recapture tax rates, all the different tax rates for the investor, and we've assumed the inflation increases. So at this point in the game, we can look at the return side, and we can see that in 5 years, our appreciated value would be about $231,000, and our equity buildup would be up to $82,000 in the property. Now, for commercial real estate, you're not going to be looking at this, especially for the appreciation. Commercial real estate that use cap rates, which we'll get into, but this is just for basic investor. You can see, hey, in 5 years, this is where I think the property could be worth based on the historical inflation assumptions of this area, right? All right, so now with that established, we can move on to the actual pro forma. So the pro forma is split up into 3 parts, really. First off, you have your NOI. After NOI, you have your before tax cash flow. All right, so that's the next major item. Now, you can go as far as to go into a part 3, which is the after tax cash flow, but I don't want to muddy the water with the understandings because effectively you have returns for before tax and after tax. So right now, let's just start with before tax. Let's hide the after tax column. So let's start with NOI. Gross income, you start with your gross rental income. How much can you actually charge at that property? Gross, market. Then you take off your vacancy, which you could assume 10%, whatever your vacancy is in that area. Then add in other income. So other income could be pet rent, storage rent, detached garage rent, that kind of thing. All right. Then we take out our operating expenses. What is your operating expenses? Operating expenses are anything that is going into the operations of the property. All right. Daily operations. You could think of them as recurring costs, but again, it's more operating costs. Once you have your effective gross income, you take out your operating expenses, you're left with your NOI. When you have your NOI, at this point in the game, you can then begin to look at some return metrics. Now, this is why so many people like the cap rate, because right now we don't have that much info. We have the NOI, we have some deal assumptions, and we can get a cap rate and a gross rent multiplier. So first off, you have a gross rent multiplier, which is effectively your property value divided by your gross rent. And so the lower the gross rent multiplier, GRM, the more attractive the deal, effectively. Cap rate is similar, but it uses your NOI, and it's based off a percentage instead of a multiplier. So this means it's your NOI divided by property value. So you can think of it as your unlevered return. Unlevered just means no debt. So again, at this point in the game, we've not introduced debt at all into our operating statement here. All things equal, you would want a higher cap rate as a buyer. As a seller, you want a lower cap rate. Moving into the loan metrics, so you can also go as far as to understand debt yield and DSCR, which is really the debt yield is effectively the lender's cap rate. It uses NOI divided by the loan amount. Then you have your DSCR, which is your debt service coverage ratio. So this is your NOI divided by your debt service. So NOI, this amount divided by your total mortgage payment, which is your debt service. So how many times does your NOI cover your debt service? So if you're above 1 here, you're doing pretty well. All right. That means that you're actually covering your debt service. If you're below 1, you might want to look at a different deal. That's probably not the best deal. Part 2. All right. Part 2 is your before tax cash flow. So now we're going to introduce things like oddball expenses. So if you have a tenant move out, especially in commercial real estate, you're going to have leasing commissions, tenant improvements, and CapEx, capital reserves. Once you account for all of that, these are, again, like one-time expenses. Then you get down to what people call your cash flow before debt service. All right. Once you have your cash flow before debt service, you can then take out your debt service, which again is just going to be your monthly mortgage payment times 12, because this is an annual basis here. So you have $11,000 in this case. And so with that, subtract that from your cash flow before debt service, and you're left with your before tax cash flow. Now, at this point in the game, this is where things get very interesting. You should be paying very close attention, okay? because this is where a lot of people on YouTube are confused. Let me just be very, very clear. All right, so you can basically get down to three main returns, and really these are the most important that people care about. You have your actual cash return. So again, this is your cash flow. Said differently, so this is literally just copied from this part right here. That's your cash flow. So how much cash am I actually getting in? Then you have your cash on cash return, otherwise called your cash ROI. There's some people out there that will say your best return metric in real estate is your ROI. What they really mean is your cash ROI, which they're not wrong in saying that that's a good return metric, but just be very, very careful when you're listening to people talk about ROI, because ROI can take into account appreciation, loan paydown, and cash if you're not careful. So I like to say cash on cash return to make it very clear, or cash ROI. Now the cash on cash return, cash ROI, is simply just your cash flow divided by your investment. So in this case, we had a total investment of $45,000. So that's what I base my cash flow on. Some people will do it based off the actual cash invested into the property. You can argue which way is more correct, but I would argue that from an actual investment standpoint, you would want to take all the costs associated with making that investment happen. So therefore, I would do it divided by the $45,000. ROE is effectively just at this point, we're looking at cash ROE. So my cash, in this case, my before tax cash flow, divided by how much equity I have invested into the deal. So as we go on, my cash flow ideally should be increasing on a good deal, which it is. But what you'll notice is that my ROE is going down. Again, it's based off your equity invested in the deal. So if your property is appreciating, then your equity is getting very, very large. And it's also increasing because you're paying off the loan. So this is an important metric to look at, because eventually the way to boost your ROE is to take the equity out of the deal, deploy it in a different property, and have that property also produce you more cash on that equity. All right, so before we move on to the next segment, I want to cover a few important notes about this section that we've been looking at. So first off, this first block of the pro forma is called the operating pro forma. Typically, sellers will stop at the operating pro forma because that's just all they know buyers really care about is the NOI in terms of valuing their deal, okay? Now, buyers, or a full investment pro forma, you could call it, would go all the way down to before tax cash flow, and in some cases, the after tax cash flow, which we'll get into later. But this is because obviously buyers are more concerned with these deal metrics, not just the cap rate. They do care about the cap rate, but they're going to go in and ensure that they can have a good cash on cash return, a strong cash on cash return, strong cash flow, whatever they personally prefer as an investor, they can look at that. Now, understand this. This whole segment that we've looked at so far is what we call a realized gain. Realized gain is effectively actual returns that you are realizing for tax purposes, right? Right now, every year, we will actually get this cash flow in our pocket, period. Now, this is where the pro forma technically stops. Again, now you can go to after tax, but again, for before tax, this is where we would stop. From this part onward, we're dealing with other returns that the potential buyer, the potential investor could be concerned with, and in my opinion, should be concerned with, and a lot of people's opinion should be concerned with. So I want to stress that you'll see this presented in many different ways. Again, I've set this model up in a progressive style so that we can kind of go through the returns. So just know that this is not industry standard for it all to be presented in this fact from this point onward. So again, this first part is called the realized gain. Now we're going to get into the unrealized gain. So what does unrealized gain consist of? Well, it's two things. One is the pay down of the loan that you're paying off each month, or your tenant hopefully is paying off each month. And then secondly is appreciation. Hopefully your property is appreciating and you're getting some kind of unrealized gain there. Now it's unrealized because you're not paying tax on it until you sell the property. Once you sell the property, you'll pay tax on the appreciation component. You won't pay tax on the principal pay down. But point being, this is gain that is trapped in the property. It's your equity buildup. That's all it is. Now, most people in the real estate industry will not look at it from this perspective in terms of a very detailed breakdown of returns, but I'm just showing you this for the math. All right, so if you wanted to, you could calculate an ROI. So again, before we did a cash ROI, we did the cash flow from the property divided by our initial investment of $45,000. You can do the same thing with the other two returns, the other two ways to make money in real estate, which again, principal pay down and the equity that you build up in the property from appreciation. So principal pay down, it's 4%. So I take this 1,965 divided by that 45 grand initial investment, and I would get a principal pay down ROI, quote unquote, of 4%. You can do the same thing for ROE. Now, once we are done looking at the unrealized gain, we can look at the combined gain. Okay, this is why I've broken it down like this. So combined gain will take your all three ways to make money, okay, in a real estate transaction. Takes your before tax cash flow, your principal pay down, appreciation, and adds it all up for a total before tax return at this point before tax. Now, what this means is that for the dollar return, the ROI, and the ROE, you can have a grand total of all that. Okay, so what does that mean? Well, my total return, again, is the sum of all three of those ways to make money in a real estate transaction. My total ROI is the sum of all of those ways to make money in a real estate transaction divided by the initial investment. So, or said differently, you can literally just add up the appreciation ROI, the principal paydown ROI, and the cash on cash ROI. And guess what? That equals 23%. That's exactly what we have right here. So why is this important? It's important because, again, people will say, well, the ROI is the most important measure. It's like, well, what do you mean by ROI? Are you saying the cash ROI, which most often that's what investors are referring to. You watch a YouTube video, I'm telling you, they'll say your ROI is the most important thing. And then they'll describe cash on cash return. That's not your ROI, that's your cash ROI or your realized ROI. But your total ROI consists of all the money that you're making in that deal. Same thing applies to ROE. You can add them up or divide them out. All right, so what is the problem with looking at these returns alone? Well, these returns alone are simply just the return that I made in that year. So I made an ROI total in year one of 23%, 24% year two onward, right? ROE is going down, all that. All that's fine to look at from a yearly, annual perspective, but really we're looking at this investment as a hold period, right? Let's say that we assume that we hold this investment for 5 years, which is the way that this model is set up. Then what is our total annualized return over that investment period? That total annualized return, otherwise known as the IRR, would show you something that you could compare to other investments. So this is your final bit to the pro forma, and these returns would show up on a pro forma very clearly, especially in commercial real estate. Is the IRR, again, and the equity multiple, EM. So the way that these work is it combines the unrealized and the realized gains together, and it assumes a hold period, right? So again, let's assume that we hold everything for 5 years. Then we'll realize all of those quote-unquote unrealized gains that we covered before. We'll realize all the gains based on when we actually realize them in each of the years, right? So again, it's all based off the timing of the cash flows. So this first year, we have a $45,000 initial investment. Then in year one, we have before tax cash flow. Then we'll have the sale price, the reversion value they call it in real estate. So I'm modeling this just based off that basic assumption we made before. We said all the home prices increased 3%. So by year 5, it's about $231,000. Now in a commercial deal, you will actually use the cap rate to determine the real reversion value. But again, this is a residential model, so we're kind of making things simple. Now it's important to note that your appreciation is captured in this part, right? Remember the unrealized gain from before, this appreciation is being captured in here, the sale price, right? Then you'll have some selling costs based off that. You can assume 1%, just a safe estimate. Then there's the loan payoff. So this takes into account the principal paydown from up here. But again, instead of before it being, us looking like it's realized when it's really unrealized in each of these years, we're getting all of that total value at the end of year 5, right? When we sell the property. So in total then, for year 5, we're left with $86,000 of cash flow. So the IRR will look at the total of each year, all those cash flows, and it'll, again, give you an annualized return over the entire investment. Then you also have the equity multiple, which is effectively just how much did I increase my money by over the whole period. So in this case, it's 2.3 times, because again, I put down $45,000, and I turn that into $59,000. And so effectively what that means is that you have a 2.3 times equity multiple. Now, here comes the kicker. You can do everything that I just said, but on an after-tax cash flow basis, all right? So let me open up these cells here. After tax, boom, you have after-tax cash flow. Well, once you have after-tax cash flow, you can then have after-tax equity. You can have after-tax annual returns. You have after-tax hold period returns. I'm not going to get into the weeds of that after-tax cash flow bit, but again, I want to stress that I'm going to be going in each of these sections in much greater detail in separate videos, and I'm going to be going over, what kind of assumptions that you need to be making, what kind of, when does it make sense to use certain returns in certain scenarios, what are good return metrics for cap rate, for GRM, that kind of stuff. So if you want to see that, subscribe for the journey, leave a like if you enjoyed the video, and I will see you in the next one. Peace.